So coming into the last week of August, here we go. If you take a look at the screen here in front of you, you can see there's a lot of red on the screen. I see the majority of stocks and the majority of opportunities are pretty much in the red. For instance, today, 88% of what I'm looking at has a bearish opportunity, and that stays in the 80s all the way through the rest of this week. And September, well, September is not that much different until you get to the back half of it. So we are looking to be bearish through Labor Day. And what I want to talk to you about is what I call the top 5 bearish trends in ETFs going through Labor Day. So let's talk about that. You know, if you look at the market indices, we're really kind of mixed. If I were to take a look at just at all the ETFs, it's, we were to take a look at the Dow, the S&P, the NASDAQ. All right, we got some mixed opportunities. Tech is really kind of propping things up. When you look at older stocks, you're seeing them kind of pushing the way down. And like I said, this pattern happens through the first half of September. So let's dive into and look at what is very decisive in terms of bullishness or bearishness. And really the decisiveness in the next 30 days is on the bearish side. Top 5 ETFs that are decisively bearish starting right now are: number 5, the FXE Euro Trust. Okay, this is a currency share that mainly focuses on FXE versus a foreign basket of currencies. The chart you see, or the table you see in front of you, is if you were to have been bearish and shorted it. 9 of the last 10 years, you would have been right. Several times, this currency share dropped over 2.5% during this time frame between September and October. A current chart of FXE shows that it has been hitting a resistance area just above 108, call it 109. More importantly, look at the 60-day implied volatility. That's the options premium. The blue line you see there, the blue line was high, but it's very, very cheap, coming down here around 6. Not once, not twice, not 3, not 4, but now 5 times it's gone below the yearly lows. Says calls and puts here. Very, very cheap. Number 4. Now, sometimes we got to go bullish in a bearish market. And to do that, when the market's bearish, the double dollar index, or UUP, is the way to fly. If you want to buy something that goes up when the market goes down, this is a good opportunity. For 9 of the last 10 years, UUP has come in as the number 4 ETF that moves when the market goes lower, although this one goes higher. And so over 9 of the last 10 years has moved higher by an average of about 1.9%. But take a look at the last couple of years. 2022, 2%. 2023, 3.74%. And last year, nearly 4% move on this double dollar index. Current chart looks like this. Now, UUP has gone down. If you can see the beginning of the 6-month chart I have here, we went from 28.6 down to 26.8, have come back, and we've hit that area of resistance up here. This is the 62% resistance area, just below 28. We then hit the 38% resistance at around 27.5. We've come decisively below that. But again, what are we looking for? We're looking for this to move up during the months of September and October. Options? Well, they're as cheap as they've been in the last 6 months. So call options look interesting for UUP over the next 2 months. Number 3, the Japanese yen currency share, symbol FXY. FXY drops 9 in the last 10 years by an average of 2.5%. And notice this, it's gotten on average better and better and better. Biggest move, 6.29% back in 20. Hey, you want my latest money calendar? My live strategy session? My top patterns for the month? I'm Tom Gentile, America's pattern trader, and you've got it. Just scan the QR code below or click the link below, and you can get started for just $9. 2022, Now remember, 2022 was a bearish year in the market. We started to make the turn to the downside. Last year, however, in a bullish market environment, the yen fell 4.74%. So, FXY, what's it look like right now? Looks like a lot of the same. I see the yen making lower highs and lower lows for the last 6 months. The bottom came down here around 61 before it rallied up to the 38% retracement at 62.78. That's going to be in a hard area to move to the upside from. Volatility, while it's not the cheapest, it is much cheaper than it has been on the graph. So option volatility is cheap. It's also trending down. So not only seasonally it looks bearish, but on the trend it looks bearish as well. Number two, let's move outside of currencies and let's look at XLP. That is the Consumer Staples ETF. XLP also has dropped 9 in the last 10 years. More importantly, 9 years in a row from 2016 to last year, 2024, has been profitable during this time frame, the September-October time frame. Best year? Well, that was 2022 when it actually moved down 9%, right? Drop 9%, sell high, buy low, do well in the last couple of years. Well, last year, not so much, but overall, this is a 3% mover on average. What's it looking like right now? Well, look at this. It's actually one of the high flyers as it's up to near the year-to-date highs up here around 83. So what we'd be looking for if seasonality were to repeat itself once again would be a pullback, right? And pullbacks to go where? Somewhere around the 80 target range would be the area that we'd be looking for a pullback, because that is the 50% retracement level from the low to the high on this chart. It's also an area where we're seeing a lot of support, about 5 times support down here near 80. Options, well, they're also at their year-to-date lows, so buying put options on this one, if it makes sense, well, it definitely makes sense as far as the values are concerned. And the number one ETF in terms of things moving south for the next 2 months, well, you got to look at the bond market. TLT has dropped an average of 6% in the September-October timeframe on average the last 10 years. 10 years in a row on this one. Well, yeah, 2015, it had a fractional move to the upside, but over the last 3 years, 15%, 13%, 5%, really halves, 16.5%, 13.5%, 5.5%. Those are big, big moves. What's the difference this year? Well, what could cause a kink would be if the Fed were to lower rates more than we expect them to potentially lower in September. But if they come in and if they lower as expected, I think this chart's going to do exactly what it's done the last 10 years in a row. It's going to move down. We're going to see rates really stay the same, and the Fed will come down to where TLT is right now, and we'll be looking out into year's end. What's TLT look like right now? Well, looks a lot like this. Really is kind of a downtrend, but a lot of sideways action here this summer with highs are in the high 80s and the lows down here in the low 80s. We would expect once again that kind of that move to happen one more time. Options, by the way, on TLT, like everything else, very cheap. Look where they were. And if you look at the blue line, you're talking about the low 20s for implied volatility on options. They're down to 12 right now. We're talking about options now are almost 50% off. There's a 50% off sale going on right now on TLT on the 60-day options. So when you wrap all this up in a nice bearish package, it looks like this. Bonds and foreign currencies trending lower, not just seasonality, but trending lower. UUP is mixed. Staples are trending higher. And here's the commonality. All of these ETFs have cheap options. So, like I always say, do your own homework. But if you're a seasonal trader and you're looking at not just seasonals, but potentially trends, then this might be right up your alley.